I want to return to what does seem to be a perennial favourite topic of mine, and that is this notion of where you look and what markets you trade and when you trade them is, in my opinion, perhaps the final arbiter of your success. I understand there are many people who bang on repeatedly about stock selection and the like, whether the stock has a good story, whether it has good prospects, what the narrative is telling them. But in my world, that's an irrelevancy if that particular stock with that particular good story is simply in the wrong market segment. Picking those stocks will not generate the sorts of gains that you want to see within a portfolio, particularly within a trading portfolio. And what has prompted this piece was, in particular, this article that appeared in my newsfeed from the AFR. And the title is, "It's Time to Look Beyond the ASX Large Caps to Make Money." And whilst I don't want to be churlish in my response when I read this was simply, well, no shit, Sherlock, where have you been? And the article does make the point that in Australia, we have very concentrated benchmarks. One of the things that's necessary to understand about the Australian market is it is banking and resource and small dog spec stocks. That's it. There is nothing in between. The indices themselves are very, very concentrated, and their performance is very concentrated simply because of the small size of the market and the relative large size of many of the stocks within this particular market. And we can actually see this in this somewhat chaotic little graph I generated. This is the value of $1 invested in the ASX 20 total return, the ASX 50 total return, ASX 100 total return, 200 total return, 300 total return, and the All Ords. You can see they cluster. They are very, very heavily correlated, and this is simply to do with the weighting of the stocks within them. This is just a function of our index. There's nothing that you can really do about this. The Australian stock market on any given day is around about 2% of world market capitalisation. It does not have the innovative, energetic technology sector of, say, the US markets and the NASDAQ 100. We're simply not set up for that. But that does not mean that the market itself does not generate opportunities that are worth taking. What it means is that you have to be very selective in the markets that you look for these opportunities. What is also important to note is the outsized impact of dividends upon Australian markets. This is the All Ordinaries compared to the All Ordinaries total return. The total return index is the price index itself, but with dividends folded back in. It's important to understand the distinction for this because as traders, we're not really interested in dividends. What we're interested in is price change because it is the price change that generates the returns we want. We're not really interested in sitting around the bowls club having a banger in bread talking about the fact that XYZ stock just paid me 4% fully franked. That's not going to make you rich. That will undoubtedly offend many people who do sit around their bowls club having a banger in bread talking about their stocks giving them 4% fully franked. But that's simply the way the world works. And if we are to look for markets where these opportunities occur, the moment we step away from these major indices and we begin to look at sub-indices, you start to get a sense of where outlier opportunities occur. And in particular, looking at the smaller industrial, smaller resources, particularly the resource sector, shows that it has this boom-bust cycle. Boom-bust cycles are very distressing to traders, but they're much more distressing to investors because investors just sit there like a deer in a headlight, believing that Bob's Dodgy Mining in Western Australia that they bought for 50 cents and which has gone to $1 is going to go to $100, when it's actually going to 2 cents, and they just sit there and wait. Traders take a different view. No, let me rephrase that. That's wrong. Traders with a plan take a different view. And the view is simply that the market exists for their enrichment, but it only exists at certain points for their enrichment. And they have to be aware of where those particular inflection points are. They have to be aware of the fact that if you are trading small resources, then you're going to have to put up with the sort of swings and roundabouts that they generate. So you're going to have to be more active, you're going to have to be more prepared. You can't just buy small stocks, hang on and hope. Because what I generally see, and I've talked about this in previous videos about a colleague of mine who gave back $7 million, sitting and waiting, believing the narrative he had been told, is that you have to be active. You have to have a plan for trading them. So that when the time comes to exit, you exit. But if we begin to break down returns and have a look at some of these particular returns that are generated, you see they're dramatically different from the return that you might get by buying ANZ Bank. And these returns are split over 3 time periods, previous 52 weeks, 2 years, 3 years. We do have to be a little bit careful when looking at these sorts of returns because they don't actually give you an indication of the trajectory of price during that return. But this throws us back to the notion that these are active engagement stocks. You don't just buy them and put them under the bed and then give them to your grandchildren because they won't be around. If you recall from a previous video of mine, you will remember that the majority of resource stocks listed in Australia eventually disappear and they simply come and they go. But that's all right because they have served their purpose for you. And remember, their purpose for you is one of enrichment, nothing else. Markets serve no function other than that of personal enrichment. Yes, I know those of you with an MBA will be sitting around but going, hang on, a market's purpose is one of firstly valuing a business through dissemination of information to a market where a price is decided upon. Secondary to that, it can be a mechanism of capital raising for new businesses to invest and engage in innovation and the like. No bullshit, they're there for me to buy a Porsche, that's it, nothing more, nothing less, we move on. So what's our first observation? Our first observation is that within the ASX, you'll not find outlier moves within a major index. You just won't. It's as simple as that. There is no way around that. If you are going to trade the ASX, then you need to understand that this is the domain within which you operate. Nothing you can do about that. If you don't like that, well, then the easiest sort of pathway for you is to buy an ASX 20 ETF, put it under the bed, every so often put money into it, hope for the best, get the index rate of return. But moving on, the article also went on to talk about this notion of equal weighting of stocks within an index. For those who are not familiar, an index is made up of stocks that have varying weightings generally based upon their size. An equal weighted index does away with this notion and says, well, what we're going to do is give everybody the same weighting. And I want to touch upon this last paragraph. So be warned, this bit is a little bit geeky, so if you're not really into geeky things, switch off now. Particularly its final sentence where it says this equal weighting approach is well supported by academic and imperial research. And the moment I hear a statement like that, I do actually have to go to the original source. So I fire up the capacity to look at these things, and lo and behold, within academia and empirical research, it is well supported. But there's a little bit of a problem. And the little bit of a problem is this. These are a series of equal weight indices versus their standardly constructed counterparts. Here's the Dow. The ordinary Dow outperforms the equal weighted index. Here's the S&P 500. The standard construction S&P 500 outperforms its equal weighted counterpart. And the situation is even worse when looking at the NASDAQ 100. So this brings me to my second observation. In general, academia and testing are not the same as the real world. There is a disconnect. And you have to be aware that thinking and experimenting with something is different from doing and applying something. And they are dramatically different. But there is a little bit of a wrinkle in this. And the wrinkle is that when we come to Australia, this is the particular Van Eck fund that the author of this article was talking about. And you can see that for this time period, it underperforms STW, which is the ETF covering the ASX 200. But as I've said before, we need to be very careful about timeframes because you can actually make them say almost anything you want. If you pick the right starting point, then everything looks rosy for your argument. The sort of great proponents of this are people who look at gold. Strangely enough, they always pick the point to begin their price discovery and surveying of the price of gold at the exact low point before gold takes off. And they say, well, look, it's magnificent. Yes, but if you go back 6 months before that point, all of a sudden it looks very, very poor. And so if we widen out the time frame, we get a different perspective. And so you see that we run into this issue that there does seem to be this dislocation between what happens with equal weighted funds in the US and what happens with equal weighted funds domestically. And that does raise the somewhat interesting question as to why is there this dislocation? Why do they look different? You would assume that if there is a universal rule, then the giveaway is in the name, universal rule. It should apply everywhere. There should not be these idiosyncrasies where you get dislocations. Part of the giveaway, or part of the answer, I'm not certain whether the author actually understood that he'd come up with an answer, is that the returns are what are known as ergodic. That is, not all members of index contribute equally. And the giveaway is in the last sentence. It says that history shows that a few companies will make an outsized contribution to the overall return. So when we begin to look at the overall return domestically and on the US of indices, we begin to see something interesting. And here I've taken the ASX 20, which really is the driver in terms of price returns of every other index, simply because of the way it's weighted, versus the NASDAQ 100 and the top 20 in the NASDAQ 100. All of a sudden, something becomes blindingly apparent. In the top 20 of the NASDAQ 100, there are no negative returns. In the ASX 20, there are negative returns for a year. The best performer is Goodman Group with an 80% return. The best returner on the NASDAQ 100, when I snipped this, was NVIDIA with a 251% return. Next best Constellation, 158. Next best Meta, or formerly Facebook, 145. CrowdStrike, 141. DoorDash, 128. Broadcom, 111. Netflix, 95, and we go on. The average return of stocks in the ASX 20 for this particular year, 12.55%. The average return for this particular snip from the ASX 100, 100%. So you have dramatically different components within an index, are dramatically different in terms of the energy and vibrancy they actually bring to the market itself. You get a sense of how moribund our domestic indices are, and why, again, we loop back to that point that buying stocks within a major index is a fool's errand. You need to look beyond that. And when we look at weightings, you can see that weightings do play a part, and particularly in the NASDAQ 100, you can see that NVIDIA is weighted at 6.5%. In an equal weighted index, that's brought down. So it doesn't contribute as much. We come back to this statement that a few stocks make an outsized contribution to a standard index. And actually, that's what we want. We don't want to in any way try and handicap that. Yes, there is the flip side that if you have a large weighted stock that is underperforming, then its underperformance is brought back. But you're still cutting your nose off to spite your face. You actually want that discontinuity, that weighting, to actually give you some form of drive. So we come to another observation, and that is that within the ASX, equal weighting simply equal weights mediocre companies. If we go back to our list, these are all staggeringly mediocre when compared to the earlier list, which I will revisit, of the smaller stocks for their one-year return. You might think that Goodman at 80% return is impressive, but when you are looking at other stocks which have returns of the several 100%, it begins to look fairly poor. So I come back to a variation on my question about where do returns come from? And I want to phrase this within the sort of universe of where do returns come from for traders? Well, the answer is quite simple. It comes from stocks outside the index. It comes from stocks you would not ordinarily consider. And it has to come from there. What catches people out is the way indices locally are constructed. In that what will happen is they will look at many of these stocks, and the example I'll use is Chalice Mining from the boom a few years ago. People will open up a list of the ASX 300 or the All Ordinaries, and they'll go, well, I'm scanning these and Chalice is in there. It's in there now. It wasn't in there when it took off. In Australia, stocks are graduated into an index. They move into them as their price changes. So a stock might ordinarily hit the All Ordinaries. It continues on, it moves into the ASX 300, continues on, moves into the 200, continues on, moves into the 100. The problem is by the time you've noticed it with your scanning of the ASX 200 or 300, it has already had the bulk of its gain. You've missed out. You may convince yourself that you would have seen it, but you would not have because it's simply not within the purview of your scanning universe. And so this brings me back to my final point, and we've looped back a little bit. And this is the point I want to end with. It is simply that within the ASX, you will not find outlier moves within a major index. You must set up your scanning universe in such a way that it does troll the market for these particular stocks. And you need to accept that many of these stocks will perhaps be outside your comfort zone. But then you have to balance comfort with profitability. And the true final point I'll leave you with is that in trading, if you are truly comfortable, you're actually doing it wrong.